Hey, what's up, stock compounders? Brad here. So I was doing some poking around in the corner of Berkshire and Fairfax community, and I came across this. It's a report from the summer interns for Alta Fox Capital. And they basically spent the summer of 2020, this year, um, trying to find the best performing stocks from around the world over the last 5 years. Okay. Stocks that did at least 4.5 times over the last 5 years between 2015, June 2015, and June 2020. So the minimum was a 35% annual return, or a double every 2 years. That was the minimum kind of performance cutoff. So I wanted to go through this report with you guys a little bit because it's just fantastic. There's so much good stuff in here. They spend so much time on this. And there's some really, really good insights, I think, that come out of this report. So what did we do? Analyze the highest performing stocks over the last 5 years and identified common characteristics, trends, and catalysts. Why? To identify strategies to find the next set of high performing stocks, something we all want to be able to identify. Right, so there were 104, as you can see right down here, 104 stocks that met the threshold, right? That kind of satisfied these criteria that they were looking for from around the world, 104 stocks. And each of those stocks got like a 6-page write-up, which we can see at the end of this slide deck. So just so much work that went into this. So this shows the criteria for selection. Stocks in North America, Western Europe, and Australia were included in the study. All sectors, and like I said before, total shareholder return needed to be 4.5x or greater. It had to have a positive trailing 12-month EBITDA. Market cap at the end had to be between 150 million and 10 billion. There's had to be a certain level of liquidity. And then you see the latest fiscal year-over-year revenue growth was positive. So you can't have a fall off in revenue over the last year. And the stock is actively traded and the primary security for the given company. So let's get into some of the more interesting stuff here. So this was really interesting to me. So relative to investable universe, okay, this is kind of all of the stocks that were looked at. You can see these sectors, what percentage they are of the investable universe, and then what percentage they were of the set, the 104 stocks that met these performance criteria, right? That's annoying. I'm going to reset that. So you can see which sectors kind of outperformed relative to the whole investable universe. Technology definitely outperformed. There were a lot more technology companies that made kind of the final list as compared to the number of technology companies. You can see healthcare also significantly outperformed. So that's kind of interesting. The geographic breakdown, you can also see relative to the investable universe, North America was almost half of the total investable universe, and it was less than a third of what was in this final set of 104 stocks that met this performance criteria. So you can see here how kind of the country level breaks down. The U.S. underperformed. There weren't as many companies that made the cut as compared to the number of companies that are represented by the U.S. It was interesting to see quite a bit of outperformance from the UK, from Sweden, Australia, Germany, and Norway. Okay, those 5 countries, there were, as a percentage, there were more that met the criteria of this study um, proportionally. So that was interesting. That leads me to believe that, maybe there aren't as many investors in looking at these small cap stocks in these countries as compared to the number of investors who are looking for these opportunities in the US or Canada or France or Denmark, some of these other countries. So there's that. You can see stock exchange representation. Where did these stocks come from that made the final cut? 15 different stock exchanges across these 3 geographic areas. You can see the number of the company sizes back in 2015 and what they were in 2020. Obviously, there was a shift towards being a larger company. That's a big part of where you get your growth numbers from. Companies growing in size. So there's that. We've got the revenue breakdown. This was really interesting. So what caused this set to outperform? That compares it against the S&P 500. But this next one is really interesting. So what drove the growth? EBITDA growth. The median for the EBITDA growth was only kind of for about a third of the growth. When you're looking at the growth, the median figure for growth, which I prefer the median figure over the average, because when you have really outsized numbers, that can really skew the averages, but it doesn't affect the median numbers. So I think median tends to be a better representation. So a third of the growth came from kind of this earnings growth, whereas 2/3 of the growth came from multiple expansion. That's a price to earnings ratio. Started out small, and over those 5 years, that PE multiple expanded quite a bit. So I thought that was interesting. It's a reminder to me. I mean, I kind of know this. I keep this in mind most of the time, but price to earnings ratio, it's important to buy, on the cheaper side with respect to price to earnings ratio, and hopefully identify opportunities where you're going to get an expansion over time in that price to earnings ratio. A lot of good numbers here to dive into. But let's get into some of the other stuff. So high-level takeaways, okay? Look for businesses with advantageous positioning. 80% of businesses had moderate to high barriers to entry. 91% had moderate to high competitive advantages. This is really about the moat, right? How easy is it for competitors to come in and take market share away from these businesses? It's important to have some kind of protection from that. Spend time on financially healthy companies. 88% of outperformers came from a position of financial health in June 2015 and grew faster than the market may have anticipated. So financially healthy companies rather than turnarounds, right? So, my sense of what that means is, really pay attention to debt levels. You want to make sure, free cash flow as compared to debt is healthy, right? And everybody's going to have a different idea exactly of what that means. But if you're too leveraged, if you have too much debt, it's really hard. It can be really hard to make it through periods of challenge. So it's kind of what this point, I think, is getting at. This was interesting. Acquisitions can create value. While many acquisitions fail to create value, The highest performing stocks often leverage acquisitions to bolster their returns. If you're looking for phenomenal returns, finding companies that make strong acquisitions, that make acquisitions well, intelligently, will increase your odds of success. So that was a little counterintuitive to me. I usually try to stay away from acquisitions. But these companies being in the technology space, in the healthcare space, it's possible that acquisitions are a bigger part of growth in those spaces than industries that I'm more familiar with. So that just expanded my mindset a little bit there. Don't rely on multiples. Well, it's always better to buy a great business at a low multiple rather than a high one. Many of the top performing stocks began with already healthy multiples, right? Healthy meaning higher than most value investors would probably like to see. And Chris Meyer in 100 Baggers mentions this as well. A lot of these 100 baggers that were uncovered through Chris Meyer's study found that they didn't necessarily start with a PE ratio that was low, considered low by many standards. So maybe we shouldn't fixate too much on low PE. And then 5, be open to international companies. Many of the best performing were American, right? However, the USA was underrepresented in the set, meaning it's less likely that a company in America would achieve greater than 350% returns compared to some other countries, right? So that's a very interesting point. And then we've got specific takeaways here. And then we'll get into a few of the different actual stocks that made the cut, the highest performers. If we were to screen for future multi-baggers, that's what these takeaways are all about. We believe the following criteria would return the highest percentage of success. Companies in the UK, like I mentioned before, UK, Sweden, Germany, Norway, and Australia. These countries were overrepresented in the set, likely because of their strong rule of law, quality educational institutions, and favorable economic conditions. There also I think this is maybe even the more important point, there also tend to be less initial coverage of smaller stocks in these countries than in the US. Like I was saying before, potentially less investors looking for those small opportunities in those countries, which may be due to lower populations of small cap focused analysts and investors. Industry, companies in technology and healthcare, right? Those were the two industries that were overrepresented in the set, likely because of often low unit costs, high gross margins, high operational leverage, it's a little scary, and growth opportunities. The aging population and an increased reliance on tech software for everyday life have and will continue to be strong tailwinds for the growth of these industries. It makes a lot of sense. Clearly, we have kind of a baby boomer population that's coming into retirement age and are going to need more and more support. So that is a pretty strong tailwind for healthcare. And obviously, we all see what impact technology has had on our lives and continues to have at an exponential pace. Size, companies with market caps below 2 billion. Companies below 2 billion represented 84% of the set, right? Back in 2015. Often because of low analyst coverage and institutional ownership, right? Low on both of those fronts. So there's not as much efficiency. There can be more mispricings when you have that. Fewer eyeballs looking at those opportunities, essentially. And then smaller companies often have more room to increase their share of the target markets relative to larger companies, which often have larger market penetration, right? So you have a small company as compared to the market size, right? The market opportunity, there tends to be more of a delta there. So they can, grow for a number of years before kind of filling up that market niche. And then multiples, companies trading below, these various multiples. 82% of companies from the set traded below these multiples here or without forward multiples 5 years ago, which leaves room for multiple expansion. And as we saw, that drove a substantial amount of the total shareholder returns. So let's get into a few of these. Like I said, there's 104 companies, 6 pages on each one. Just so much work. And you can see here, if you have any questions about particular companies, you can see here who did the research on that. In the beginning of this report, if you recall, I think there's email addresses associated with each of these 3 summer interns. So they're probably receptive to questions if you want to go deeper into these. So you see here the 5-year total shareholder return for Zynex, like 93. We got a 93 bagger in 5 years, which is incredible. And it talks a little bit about what the situation was in June of 2015 in terms of stock price, market cap, enterprise value, shares outstanding, and then today, or in June of this year, what the situation was. So you get a sense for where some of the growth came from. It talks about the product, what the business does, competitive analysis, what's the competitive landscape for this company, barriers to entry, competitive advantages, risks, what's changed in the industry. With barriers to entry, it talks about, are there low threats of kind of competition from other companies, medium threat, high threat? What investors missed. So this slide is really discussing why it could be bought at a very attractive entry point 5 years ago. The bear thesis 5 years ago. Why didn't people really want to get into this thing 5 years ago? Which is really cool. That's awesome that they went into that. And then you got Zynex takeaways. What's the quality of the business today? This gives it a 2.5 out of 5. You can see the future outlook as well. Can Zynex sustain its market position? Can it continue to grow faster than the industry? Is it poised to continue to outperform the market? So, in some of these 104 businesses, there may still be opportunity for growth, right? They've grown a lot over the last 5 years, but a lot of these are still very small companies. So this slide is kind of like, well, is this company worth taking a dive into based on, where it's at in 2020? Or, are there reasons to think maybe it won't outperform moving forward? So really valuable slide here. Zynex, not super compelling, at least from this slide, looking at the future. You can see the second top performer, Endor. Looks like a company from Germany. This was an 83 bagger over 5 years. This looks like it's all about this kind of gaming console product, a racing wheel and base. Kind of interesting. Yeah, guys, take a look at some of these. You look at the last page here, Endor takeaways. Says it's a good business, 4 out of 5. The future outlook, can it sustain its advantages? They think yes. Can it continue to grow? They think yes. Green check mark. Is it poised to continue to outperform? Yes. So, Endor might be worth taking a look at today. One thing I did is I pulled out kind of the top 7 U.S. companies out of like the first 40 results in here to try to get a sense, how attractive are these today based on different value metrics. And what I came up with is that they all looked quite expensive to me. So So there weren't really any out of the top 35 or 40 that I'm interested in taking a deeper look at. But if you guys are in international markets, if you're in Australia, if you're in some of these markets that were shown to have more representation, like UK, Sweden, Australia, Germany, Norway, it could well be worthwhile to look at. All right, which companies in here are in your jurisdiction, are in your country? Could be some great opportunities. So just want to give a huge shout out to Alta Fox and the summer interns in 2020 for creating this report. I actually sent this report to Chris Meyer, the author of 100 Baggers. He had already seen it, unfortunately. It didn't surprise me. I was hoping to gain some bonus points by sending this to him, but he had great things to say about it as well. It's just a high quality report. So I will link to this in the description. Definitely check it out. I've sent it to a few of you folks over in the Australian market already, but take a look and let me know. Let me know in the comments what jumps out at you, what you're going to take a deeper dive into. I'm very curious to hear from you, and hopefully this is of some benefit. If not, specific stock ideas, just kind of letting the methodology, letting some of these factors, hopefully they help you become a better investor, make it onto your checklist, or just kind of shape how you think about identifying these long-term compounders, because that's such a big part of the game here for us value investors. All right, guys, I will leave it at that. Again, if you haven't gotten a membership to Corner of Berkshire and Fairfax, I don't get any money for saying this. It's just a fantastic community of really smart investors. And it's like $23 US for a lifetime membership. So the more I dive into that, the more I find value in that resource. And this is just one example. So again, that's all I got, guys. I will see you in the next video. Take care.